So imagine you're in front of your chart looking for a trade setup. The higher time frame is bullish and you see a clean fair value gap on a lower time frame below market price. So you decide it's a great place to set a buy limit order for an entry long. Stop goes below candle 1 of the fair value gap and you target the equal highs above. It looks textbook. So you wait and you watch price come back to your entry. But instead of finding support at the gap, you watch it cut straight through it like that gap didn't even exist. And before you can even react, your stop gets tagged. Trust me, I know that feeling. It wasn't until I understood one specific thing that it all started to make sense. Not every fair value gap is created equal. Some are entries, some are targets, and some are just traps. Knowing which is which doesn't just improve your trading, it changes the way you read price completely. In this video, I'm going to show you exactly how to tell the difference, when to anticipate price running through a gap, and when it will respect it. And by the end of this, you'll never trade fair value gaps the same way again. Let's get into the charts. All right, so here we are on a 5-minute chart for NASDAQ. Now, I want you to just look at this piece of price action that we have here in front of us. Now, clearly, we understand that here we have a fair value gap, right? Between this candle's high and this candle's low, prices traded in one direction only, buy side. Therefore, this is inefficient price delivery. And we anticipate the market to run lower to balance this area of price by offering sell side delivery back through this range. Now, that's what we understand about fair value gaps. But in this scenario, we also have a fair value gap here, and we also have a fair value gap here. So one of the problems that we encounter when it comes to trading fair value gaps is which one is the high probability fair value gap? Which one should hold as support? Which one is going to be a draw on liquidity? Which one should we take an entry from if we're continuing higher? Now, for argument's sake, the higher time frame is bullish. So we anticipate to look for a long entry, right? Now, for the purposes of this, obviously, teaching video, let's say that we had just arrived to our charts and this is what we're presented with. In order to predict what price is going to do next, naturally, we have to look at what price has previously done. The first thing that we can notice here is we've seen a raid on these highs over here, and we've seen price travel through the opening price of this last up close candle out of these consecutive 2 up close candles. So we can identify this as a change in state of delivery, and this is an order block that raids buy side liquidity here. So typical high probability order block. We also see price close through this low. Now you can see all of this price action was contained above this low. This displacement through is a significant break in structure. Coupled with the buy side raid, coupled with the change in state of delivery, we can now start looking for price to spool lower. In this case, these fair value gaps would essentially be acting as a target, or essentially a draw on liquidity to pull price lower. But which one is it likely to reach for? Now, the first obvious one is this one here, right? Because it's the highest out of the 3 fair value gaps. And if you notice, just above it, we have these relative equal lows. So we have a condition here where we have both sell side liquidity in close proximity to a buy side imbalance. So that could be a potential target if we were looking to sell short. But again, for the purposes of this example, let's say that we're not going to counter trend trade to the higher time frame. Now we are looking for long entries and somewhere where we can place a buy limit order, right? So let's take this a little bit further. We can also see that price has traveled below this low here, and we can also see a clean break in structure with a close above this swing high. Now, when we're bullish, this is exactly what we want to see. But how far can price retrace? Now, since we have these 2 down close candles inside of the leg that raids sell side below these relative equal lows, we can safely assume that this is going to be a high probability order block, and therefore the opening price of this order block should be sensitive, right? Is what we've been taught. This is a typical model. We see a sell side raid, a break in structure, price retraces into an order block that overlaps with a fair value gap. Also, if we take the high and the low, the opening price of the order block sits inside of a discount below equilibrium. So we have a lot of things here that stack together, right? So let's see how this plays out. The market drops lower as we anticipated. The first fair value gap acting as a draw on liquidity to pull price lower. And then we see the market drop into consequent encroachment of this buy-side imbalance, the 50 DRT level or equilibrium, and the opening price of the order block. So this is perfect. This fits all our criteria where we're looking for an entry. So we place a buy limit order at the consequent encroachment of this buy-side imbalance that rests at equilibrium. We place a safe stop below candle 1 of this fair value gap, and we target the relative equal highs in the form of this low resistance liquidity signature above the market. Now, looking at this with the underlying premise that the market is bullish on the higher time frame, I think it's safe to say with all the confluences, this would be a relatively decent trade. So let's see what happens. The market absolutely runs straight through the fair value gap, doesn't offer any support whatsoever. We cut straight through it and the stop gets tagged. Now, it's frustrating, but it was still a relatively good setup based on what everybody out there on YouTube is currently teaching. So we move on. We take the loss and we reevaluate. Maybe we're on the wrong side of the market. So again, what everybody on social media here is teaching is if price runs through the fair value gaps and closes through them like we have here, these become inversion fair value gaps. Now we're clearly seeing that the premium high of this inversion fair value gap and the discount low of this one, which is essentially two gaps paired together, so we're around the midpoint or consequent encroachment of those two fair value gaps stacked together, we can see that we've clearly tagged it here and price is repelled from that. So great, this again now gives us context, right? It means that the market has found resistance here, and maybe we just had the direction wrong. Maybe it wants to go lower below these relative equal lows down here. Also, we have these three consecutive up-close candles that nest inside of this buy-side imbalance. We've seen a change in state of delivery, but also look closely. We have a fair value gap in the form of this sell-side imbalance nested inside of the range of that bearish order block inside of a buy-side imbalance. Not only that, up here, if you look through the context of a market maker sell model, we have our first stage of distribution, we have our second stage of distribution, and what have we been taught? That at the second stage of distribution, you should anticipate price to really explode lower. So now we're excited here, right? Because we've already taken a full stop. So we're going to go in here and we're going to place another limit order at the low of that sell side imbalance so we can catch an institutional order flow entry drill. Our stop will go above the high of the order block. And now, of course, because we lost the last trade, we're going to be tempted here to add more size, right? Because the risk to reward in this trade isn't as great as the last one was. So, of course, we're going to go and do that. And what happens? The market runs straight through your stop. It didn't even slow down or have any resistance whatsoever at that fair value gap. Now, here's the thing. When you understand that that fair value gap was always going to be an inversion fair value gap well before it formed, you can start reading the market a little bit differently. But let's continue to see what actually ends up happening here, right? We've taken two losses. We're a little bit frustrated. And then we sit and think about it. Okay, maybe I was a little bit too keen and I got into the trade too early. Let's evaluate what's happened. Price has obviously now run above this high. We've seen the market turn around here. Now we can look at this high as our highest high and this low as our lowest low. Typically, this is what you're taught with dealing ranges, although my students know a little bit better here, right? Above the market, inside of a premium relative to this high and this low, what can we see? We see another sell-side imbalance. But this sell-side imbalance rests at the premium of this inversion fair value gap. It sits inside of a premium market. We've already seen relative equal lows raided, and now we have a layering of sell-side liquidity below the market. This is a fantastic area to take a short. And so we place another limit order at the discount low of this sell side imbalance. We place a safe stop above the dealing range high, and we target the lowest low inside of this entire range. Again, reasonable, right? This is how we've been taught to trade fair value gaps. And what happens? The market runs straight to our stop. Again, we barely got into any profit on this trade. That's 3 losses in a row by taking trades that on paper looked relatively reasonable, and I think you can understand why. So it starts to become a little bit more frustrating now, right? There's 3 losses in a row. And in terms of your model and what everybody's teaching you on social media, you've done everything by the book here. So now what happens? Well, let's clear all of this. Let me just get myself out of the way. We now sit and we evaluate again, right? Maybe we're on the wrong side of the market. The market's turned around over here, clearly showing an unwillingness to go lower. We're also finding support at the consequent encroachment, and we have a small fair value gap here in the form of this buy side imbalance, and we're clearly seeing price be supported. Now prices ran through this sell side imbalance, which was also sitting inside of a premium of that inversion fair value gap to the left. So of course, now this makes a lot more sense. We have all these highs above the market in the form of this low resistance liquidity run signature, with these highs being lower than the high to the left. Now it's as clear as day. We can clearly see that this is going to be the draw on liquidity. The higher time frame is bullish. We've seen the market turn around. It's respecting inversion fair value gaps. So this sell side imbalance must therefore become an inversion fair value gap. Now this is again a fantastic place to take a trade. We're going to go long with a buy limit order at the premium high of the inversion fair value gap. Our stop will be below the higher inversion fair value gap, and our take profit at the highs above. That's where all the buy side liquidity is resting, right? So what happens? The market drops lower, sweeps sell side liquidity here below the previous low, nails the discount low of the sell side imbalance, which now becomes an inversion fair value gap, which also overlaps with this buy side imbalance here, and the markets ran higher. We broke structure to the upside. Perfect. Now we're in the money. Next stop is going to be these highs above the market, right? So we continue to watch what happens. The market finds support on the down close candles, and then we see another expansion higher. Everything looks perfect here until it's not. The market, without warning, turns around at a time of day where we anticipate volatility to come into the market, and it blows through our stop. Now we're even more frustrated here because clearly we got greedy and we didn't take any profits as the market was running higher, because of course we want to recuperate the previous losses that we've incurred, right? If you were smart, at least on this trade, you probably would have moved your stop to break even, but let's assume we didn't. There's 4 losses in a row. Of course, now this is bullshit and trading's a scam and ICT doesn't work and fair value gaps are a scam. And of course, nobody can trade, and you're going to point the finger at everybody out there on social media because of course you're not going to take the blame and be accountable. So let's go back to the beginning and let's see how this actually works, right? When you have an understanding of dealing ranges and where high probability gaps are nested inside of the market, as well as understanding algorithmic price delivery and narrative, again, assuming that the higher time frame is bullish. Now, of course, this is hindsight since I'm teaching this as an example, but the model in itself is the exact same model that I'm teaching throughout basically every YouTube video that I put out there, right? This is dealing range theory. Now watch closely. We can grade the entire range from low to high. This gives us our DRT levels. I have dozens of videos on DRT levels and how to plot them, so I'll leave a link in the description somewhere if you want more information on that, right? The first thing that we can see how the market closes here through the 75 DRT level, and we have a balanced price range here. So we shouldn't really anticipate the market to come back up into this region at the moment before it delivers lower. Essentially, we are looking for price to drop into a discount and nest around the 25 DRT level. What do we see at that 25 DRT level? Well, if you look here closely, we have this buy side imbalance, where we've had sell side delivery here, buy side delivery here, and sell side delivery back through that range. So here we've repriced, we've redelivered, and then we've rebalanced. When price comes back into this area, what do we anticipate? It should hold like a brick wall. Now, let's go one step further. We also, between this candle's closing price and this candle's opening price, again, based on time, this is our new day opening gap. This is a very strong draw on liquidity, and again, it sits at that 25 DRT level. So we see the market draw into this. Look at the bodies here. It's failing to get any deeper into the new day opening gap. Stacked with the balanced price range, this is where you're going to find really strong support, coupled with the time of day between 2 o'clock and 3 o'clock. This is our London session. The market holds into a consolidation, and then overnight it drops into our London session. This is all manipulation, running the market lower. Now watch this. We have relative equal highs here. We can class this as a type 2 dealing range inside of a parent type 2 dealing range. Understanding the different types of dealing ranges are an absolute game changer, and something that I'll be going a little bit deeper into during the 5-day live challenge that I'm hosting on the 18th of May, as well as going deeper into how to create trading plans around dealing range theory and how to filter out high probability trades versus low probability trades. If you're interested in that, click the link below to grab your ticket, because it's definitely worth it. Anyway, pay close attention to, again, this 25 DRT level here. What do you notice? It overlaps with this inversion fair value gap. Notice that this gap also sits inside of the leg that raids sell side liquidity to the left and rejects from a price level where we anticipate support. The market runs higher, closes through the 50 DRT level. What do we have at that 50 DRT level? Another fair value gap. Find support there, and then the market runs higher. Now, what do we have above the market at that 75 DRT level? We have this fair value gap. I'm blending a few candles here, as well as the volume imbalance based on a higher time frame. The market eventually runs after finding a lot of support at that 50 DRT level, ends up running for the 75 level here, drops lower, retraces into the discount low of the sell side imbalance here, and then rejects the premium high once, twice, and then really rejects lower at the 9:30 opening, running sell side liquidity here and deeper into the new day opening gap. Notice the bodies here at the consequent encroachment of that gap. Again, remember that gap's nested inside of the balanced price range. And then what happens? The market runs higher, finds support at the 50 DRT level, and then proceeds to run straight through that buy side imbalance. We engineered buy side liquidity before this manipulation lower, and then ultimately we run the dealing range high, where we had those relative equal highs to the left. Now look closely here as well. From this candle's high down to this candle's low, we also have a type 2 dealing range. Look at the 50 level. See how it overlaps with the 50 DRT level of the parent dealing range? And look closely what we see at that 50 level. We have this buy side imbalance here. Price finding support. We nail the discount low here inside of the lunch macro, and then the market spools higher. Where's it going to go? Buy side liquidity that was engineered in the morning session, because that's again what the lunch macro is designed to do, and ultimately the dealing range high. It's the same piece of price action, but how you navigate this price action based on having a filter like DRT that gives you framework versus trying to just trade any fair value gap breaking structure order block because you've seen somebody explaining how this stupid simple 5-minute setup works every single day and you can retire your whole family with it. There is a faster way of doing it if you have the right information with the correct framework to utilize ICT and smart money concepts. And that's what dealing range is designed to do. If you want more information on dealing range theory, I've made a free resource that you can grab below this video in the description. It's called the DRT ebook. And again, if you want to go through this with me and build an actual framework and a trading plan live over 5 days, make sure that you grab a ticket while they still are available. So make sure you reserve your seat as soon as possible. I hope you found this one insightful, and I'll catch you in the next video.